Morning guys, Joel Frank here, market analyst for YouTrading. In today's video, we're going to be taking a quick look across markets and talking about some of the key themes that are in play at the moment. And a lot has been happening in the last couple of days. Of course, before we jump into the charts, let me just remind you about how basically last week saw a mini banking crisis unfolding in the US, particularly around banks that have links to uh, crypto and tech and sort of up and coming startups and that kind of stuff. So it started with Silvergate, then SVB, then on Sunday, Signature Bank. So three major regional, but still major US banks basically going under as a result of bank runs and then being taken over by state regulators. And let me go to the Dixie. Actually, no. Let me start with the US 2-year yield, because you can see here that we've had this huge reversal lower since last Thursday. We went to as high as 5.08%, now around 4.20%. Now, pretty much what we've seen in the wake of this banking crisis, which appears, I don't know, it's tough to say. I mean, it's Monday. We're at the start of the new week, but it appears to have stabilized for now because you've had US regulators coming out and saying that they will make all depositors whole. That's beyond the usual £250,000 insurance that the FDIC gives. They're going to give back all the money pretty much, and make sure that all depositors get their money at the three banks that collapsed. And it looks like they're going to continue to do that for other banks as well. That's the message that is assumed. And there's this new 25 billion liquidity program, which is maybe going to help shore things up a little bit at other banks as well. But in wake of all this action from the Fed and authorities to stabilize the banking sector, we've pretty much, in the space of like 2 days, had the market pricing in a Fed pivot. Now, remember, let me just draw a line on the chart here. Uh, the whole of February and into the beginning of March, we were seeing this big aggressive rise in yields to fresh multi-year highs. Now, this was markets pushing back on the Fed pivot narrative that had earlier on in the year and towards the end of last year been gaining ground. Inflation data and other data had been coming in hot since the start of February, and markets were starting to rebuild their Fed tightening expectations, thinking about maybe Fed interest rates going as high as 5.5% or above at some point by the middle of this year, a potential 50 basis point rate hike later this month. That was all what markets were thinking about, causing this upside in the 2-year yield, upside in the 10-year yield. You can see that went up, now it's aggressively come down. That was weighing on stocks as well. Um, it was pushing up the Dixie, which broke out of that short-term uptrend. Of course, it's now pulling back. But let's just go back to the 2-year real quick. In wake of the banking crisis, we've seen markets pretty much go, whoa, there's not going to be much more from the Fed now. So let me just show you that actually. This is the CME's Fed Watch tool. It gives you basically the implied probabilities of what the Fed's going to do with their interest rate going forward. Now, you can see if we go back to 1 week ago, there was a 31% chance that later this month, so the next meeting is on the 22nd, so in 9 days, markets were thinking that later this month, there was a 31% chance of a 50 basis point rate hike. That's now zero. Look at that, now zero. And there's now a 20% chance of no hike at all. Now, you've had quite a few big banks and asset managers, like I think it was a Goldman Sachs and PIMCO. I might be getting that wrong, might not be PIMCO, but it definitely was Goldman Sachs, talking about how they don't expect any more hikes from the Fed now. So there's a chance that this 4.5 to 4.75% range that we're currently in is the terminal rate. I mean, markets still pricing an 80% chance of another 25 basis point rate hike. But I mean, look at this. There's still then the base case would be for another 70% chance for another 25 basis point rate hike. And then in June, I mean, look at this. It's almost like people are expecting a rate cut again by June. Like, look in May, the base case is to get to 5 to 5.25%, but then in June, the market's base case is to be back at 5.75 to 5%. So this Fed profile of expected hikes is completely shifted. Like, I mean, let me just show you this. Um, so there's only a 16% chance viewed by the market that the interest rate is still in this 5 to 5.25% range when we get to June. Now, if you just go back 1 week ago, there was only a 12% chance we were going to be in this range, but that was because markets were expecting that it was much more likely that we were going to be around 5.25 to 5.5% or above 5.5%. So massive drop in Fed tightening expectations. Markets have moved aggressively to price in the Fed pivot. So I hope it's clear now about how markets have basically all of a sudden, because of the banking crisis, priced in a dovish Fed. Obviously, weighing on the 2-year yield, weighing on the 10-year yield. All of these are back to their levels at early February now. Weighing on the DXY as well. I mean, I think there could be more downside for the DXY here because the DXY hasn't dropped sufficiently to replicate the move in yields. Although potentially a bit of a haven bid, keeping it supported. You can see here it's stabilizing above its 50-day moving average. But, you know, if it does catch on to the move in yields and if risk assets start performing better, because we haven't seen stocks rallying that much yet, then you could see the DXY drop back to this 101 area. Stocks, you can see actually not really gaining that much. S&P 500 still below its 200-day moving average. I mean, listen, banks are going bust here, so it does make sense for equity investors to be a little bit nervous still, because how many more banks are going to go bust? How many more, how much more net worth that investors have in bank equity is just going to evaporate and go to nothing, like happened 3 times last week. So yeah, I guess it makes sense for stock investors to be cautious, but listen, in wake of this massive drop in yields, big drop in the dollar, which is probably going to extend, liquidity is going to be increasing now. Um, I think stocks can climb back above the 200-day moving average, the S&P 500, and probably start challenging recent highs, perhaps from earlier this month, perhaps from earlier this year. And let me just show you crypto, because this is absolutely insane. We're seeing it in gold as well. Assets which are basically a hedge against central bank currency debasement or liquidity injections, or however you want to call it. As yields have slumped, dollars under pressure, you can see that Bitcoin's up 9% today after going up 7.5% yesterday. Massive bounce from the 200-day moving average, and the realized price is somewhere down here as well. Really, really, really bullish. Gold seeing a move for the same reason, up to 2% today, up 2% yesterday. Looking like it's odds on to challenge the recent highs. But listen, this week is still going to be a choppy week. Let's take a look at the calendar here. This is the main event. CPI. We're expecting an easing in price pressures year over year from 6.4 to 6% in the headline. Month on month core, month on month headline seen coming in at both at 0.4%. That would be a slight easing on the prior. That would be in line for the core in terms of like being the same as being the same as January. If this comes in under expectations, then that justifies, you could argue, the market's dovish shift in Fed pricing. It takes pressure off the Fed because it's almost like the Fed's caught between two things here. You still got hot inflation, so they want to keep tightening to get inflation under control, but their tightening has caused this banking crisis because it basically created all these unrealized losses on all these banks' bond portfolios, which are then translated into the panic that we saw at those 3 banks last week. So it's like, do they ease to protect the banks, or do they keep tightening to get inflation down? Well, if inflation is dropping faster than expected, then that takes off the tightening pressure and gives them more room to do the easing to help the banks. So that's what the bulls want. And listen, if inflation is a downside surprise, you're going to see gold, and you're going to see Bitcoin and other cryptocurrencies, and probably stocks as well. You're going to see them shooting higher, and it should put yields and the dollar under further pressure. But let's take a look at what else we got this week. Retail sales. Yes, US retail sales, US PPI, that's all out at the same time. Empire State Manufacturing Index, leading indicator on economic activity in March. That should be interesting. Then Philly Fed on Thursday. Then preliminary version of the U.S. University of Michigan Consumer Sentiment Report, which has inflation expectations, which is always interesting to watch at the moment as we think about basically the outlook for inflation in the US. All of these things will be very, very important, but nothing more so, obviously, than the bank crisis and the response from authorities. In terms of other events we got this week, like UK jobs tomorrow, interesting. UK budget, okay, cool. New Zealand GDP, Aussie jobs, all of these things can affect the outlook for these different regional central banks. ECB meeting, that's flying under the radar, isn't it? Barely even talked about it, but we're expecting a 50 basis point rate hike, hefty. So, whilst we've got all this talk about Fed easing, the Fed expectations for Fed tightening slumping, you've still got the ECB pressing ahead with a 50 basis point rate hike. So that could contribute to Eurodollar downside, which Eurodollar upside, sorry, which I think could certainly extend just for all the same reasons why I think the Dixie drop could extend as well. But yeah, guys, bit of a long one today because there's been a lot of excitement in markets at the moment. I'll be back with plenty more updates this week as to how things are going. I hope you all enjoyed the video. Hope you'll find it informative, and I'll see you all in the next one.